Hi, this is Phoenix here, aka Sahib. This is going to be a crash course on algorithmic trading, and after watching this video, you're going to know everything about algorithmic trading in theory, and you will be on the path to really trade with algorithms. So I really want you to add this video to either watch later or save it and watch it when you're completely free and with attention. So let's get into it. Okay, so first of all, what the fuck really is algorithmic trading, right? So you have three things here. Number one is people start with bots, right? So for example, bots would be simple rule-based automation for tasks, right? For example, you have a bot for DCA, so dollar cost averaging, and you would be thinking that this is an algorithm. Like if you have a bot, is not equal to algorithmic trading. Okay, it's just the starting point for the journey of algorithmic trading. So bots are just simple automation scripts that execute basic instructions. They're not intelligent, just small and stupid. Okay. Then you have systems, right? So systems are basically integrated models, data feeds, and risk control. So for example, if you go into Python and you want to make, let's say you want to pull the API data and to see the depth of order and the order book data. So you would have a system. It's not really algorithmic trading even at that stage. And then the third one comes execution. So you have the data, you have everything, and then you're also executing that data in a real market, and you have actual risk guardrails, or like actual risk management, and then you can call yourself an algo trader. Okay, so algorithmic trading is a systematic execution of predefined trading rules without discretionary intervention. Okay. It's not about godly bots that make money while you fucking sleep. It's about consistent, repeatable decision making under pressure. Retail traders typically overestimate bots and underestimate the importance of systematic risk management and execution quality. Okay. So when you understand this hierarchy, you would know what algorithmic trading really is. So this is what algorithmic trading really is. There's nothing more into this. Okay, now let's get into why manual trading breaks at scale. So why you should even go into algorithmic trading or algo trading. It's because humans cannot monitor dozens of markets simultaneously, and this actually algorithmic trading processes data in real time and execute sub-second decisions consistently. Okay, so then the second thing is emotional contamination, right? So for example, when you're doing manual trading, you have fears after losses and greed after wins. You do revenge trading and all of those things that will make you unprofitable. And then the third one is fatigue and regression. So it basically means performance degrades when, for example, you're tired or you're with your kids or with your family, etc., etc. And so this is all the reasons why you should shift to algorithmic trading. Okay, so now let's get into the only real edge category. So these are the only four categories in algorithmic trading. There's nothing more substantial into algo trading. Okay, so in efficient markets, edge comes from exactly four sources. Retail traders must understand which are realistically accessible. And again, this is for retail traders and for institutional traders. So which are realistically accessible and which are institutional territory. So information edge is access to data others don't have, largely unavailable to retail due to regulations and cost. But if you're an institution, you can have this information edge. So, and by information edge, I don't mean insider trading because that's illegal. But what I do mean is proprietary data sets, which are expensive. So even if you're, for example, a retail trader, but you can afford that, I would definitely recommend you to get that proprietary data set. So proprietary data set means, like, for example, in if you're trading ES mini futures, proprietary data set would mean order book depth of, like, very huge order book depth, right? Or like, for example, getting the L2 data, right, which is free in crypto, but it's paid in like US stocks and even in Forex, it's usually paid. So, and then the second one is speed edge. So speed edge usually means latency arbitrage, colocation, microwave towers, all those things. So for example, if a broker's location is in, for example, New York, and you're trading and your IP is from, like your internet is from, let's say, Hong Kong, right? So that distance in the locations would include a millisecond or even a second of difference, and that would again make you slow, make your algo slow, right? So you would want to have as much as speed as you want to have. So for example, if you're trading on Binance, which is a crypto exchange, you would want to have a location at around Hong Kong, right? And so even a little millisecond advantage can get you, I think, in algo trading very far. Okay, it can give you an advantage. So structural edge is basically exploiting predictable market behavior patterns and liquidity imbalances or efficiencies in execution. So this is where retail can compete, and this is where institutions can also compete, right? But if you're a retail trader, you can get into the venues that have low liquidity. Thus, it is being, it's not incentivized for institutions to come in and play in that venue. Let's say there's an asset that has a volume of like 1 million per day, right? Which is relatively low for institutions to get in and try to trade that. So in that venue, you would know that you're only competing with algos or traders who are retail, right? So you can at least have a structural edge in that. And then behavioral edge is basically consistency, discipline, and systematic risk management in your algos. So this is also a retail trader's most accessible advantage. And don't worry, I'll get into each of those things later on in this course and try to very simplify them. Okay, so now you need to understand what market microstructure is in plain English. Okay, this term is thrown off like a lot of times, but it is very simple. Price does not move because of lines on charts. It doesn't move because there's a support that you have drawn on the price, and it would move because of that. Price fundamentally moves because of order flow imbalances in the matching engine. What do I mean by matching engine? Matching engine is the broker or the exchange's engine that matches the orders, right? That matches the market order with the limit order. Okay, so understanding this changes everything about how you design systems. So we have to understand the order book dynamics. So let's say there are bids over here, right? Stacked by limits and orders, and then there are like asks, right? There are market buy orders, there are market sell orders, and then there's price movement. Okay, so if for example there's a consistent pressure from bids, right, and there's not a pressure from the asks, and there's also not a pressure from the market sell orders, then the price will definitely move up, right? I I used a term pressure. I did not use the term having more bids. Having more buyers than sellers. Why? Because if, for example, let's say, and let's simplify this, if let's say at a price of $100, I have bought five contracts, right? So I have bought five contracts at an entry price of $100, and the price moved to $101, right? Let's just assume that the price moved to $101. Now, it does not mean that the price has moved to $101 because there were more buyers. It is impossible that if I bought five contracts, it is impossible that I can buy five contracts if there were no sellers for selling five contracts. So if I bought five contracts, somebody has sold me that, right? So technically, for every buyer, there is a seller. So then you would assume if there's a seller for every buyer and a buyer for every seller, the price would just stay still. Why is the price moving? The price moves because of the pressure. It doesn't move because there are more buyers than sellers or more sellers than buyers, right? This is a very simple but astonishing concept for many people. And you have to understand this, okay? So the pressure from one side is what actually moves the price, which is also called order flow imbalance, okay? So let's say order enters the book, right? And then the matching engine processes the priority. So priority is determined by the price and then the time priority. Orders match when buy and sell price across, right? So if they cross, then the order would match, right? So if I'm buying five contracts at at an entry price of like $100, and there's someone selling that five contracts at an entry price of $1, $100, then our orders will cross and they would be matched by the matching engine. Okay, and then the liquidity is consumed or added. Market orders take liquidity, limit orders add liquidity, right? And this impact fees and slippage. So if, for example, there's not so much liquidity in the order book, right? So for example, if there's only at the price of $100, there's only 10 contracts selling, and I want to buy 11 contracts, then I would be hit by slippage because there's not much liquidity, which is passive, available in that price level in the order book, right? So me going in with a market order would be seen aggressive, and limit orders would be seen passive because they're sitting still, okay? You have to understand this concept. And then the price moves. When one side overwhelms the other side, price walks through the book. Okay. Momentum is order flow imbalance made visible. Okay. What momentum really is, it is not the indicators that you see on TradingView called momentum. Momentum in reality in the market microstructure is order flow imbalance. Okay, when there's more pressure from one side and not from the other side. Okay, that is momentum. I've tried my best to simplify the concept. Now let's get into the other one. Why indicators lag reality? Indicators are basically derived from price and volume, right? They are effects, not causes. That's why they're most of the indicators are lagging because they happen to process the data after the data has happened, right? So by the time an indicator signals the underlying market condition that created it has already begun. So there are three stages. So for example, price moves, right? Order flow imbalance causes the price change. This is the fundamental event that we should look into. And then the indicator calculates moving average, RSI, MACD, all those shits, all use historical price data. They're always looking backwards. Okay, and then the signal is generated by the indicator. By the indicator, by the time the indicator crosses a threshold, the move may be exhausted or maybe reversing. So this doesn't mean indicators are completely useless. They measure momentum, volatility, and trend persistence, but they are descriptive tools, not predictive magic. Okay. Design systems that acknowledge this lag and use indicators as filters or confirmation, not triggers alone. Okay. Now let's get into this strategy versus system versus algorithm. Okay. So conflating these three concepts is why most beginners fail. Each represents a different level of specificity and implementation. Most traders jump from strategy to algorithm, skipping the system design phase, which is extremely important for you. This is why backtests look great, but live trading fails. Sorry. So number one is strategy. Strategy is like the core idea, the core plan, or the hypothesis. So for example would be buy when volatility contracts, sell when it expands. It's conceptual, but it's not executable. System is the strategy plus entry exit rules, position sizing, stop loss logic, portfolio constraints, and risk limits. It's a complete decision framework. And then the algorithm is the thing that actually executes the system, translated into the code, and that executes it automatically. It includes auto routing, error handling, and real-time monitoring. So you need to have a system in place, not just the strategy. Okay, you need to see that if I'm, using the strategy, will it be affected by slippage? Will it be affected by the fees? How will the fees work out? How would the stop loss logic work out, right? And all those things. So you need to have a system, and then you combine these two things and make an algorithm. So turning a trading idea into rules. Ideas are just hypotheses, rules are executable logic. So even at, for example, at Nexus Ledger, which is my company, and we make we do trading solutions for our clients. So a lot of clients would come in and they would have, they want to make a trading algorithm, but they don't define their rules very clearly, right? So you need to have a you need to define your ideas into rules, because rules are actually the things that would make it executable, right? And the translation requires ruthless specificity and acknowledgement of edge cases where the idea breaks down. So, for example, define entry conditions. If X occurs, then open a position must be binary and unambiguous. You have to be extremely transparent with your rules and extremely straightforward. And then you define the exit conditions, like, for example, target reached, stop hit, time elapsed, or invalidation signal, never discretionary. And then define invalidation. So when does the idea no longer apply? Market close, volatility spike, or even a regime change and liquidity drought, right? So you need to define no trade zones. So, like, for example, news events, session transitions, low liquidity periods, when not to execute. And this is extremely important. Like, just note it down. It is extremely important for you to decide when not to trade. When does your algo do no trade? Okay. And write every rule as, if condition, then action. If you can't express it this way, it's not a rule, it's still, a stupid idea, or a good idea, but, stupid in execution. Okay. Risk is the real algorithm. So the core principle is your entry signal doesn't determine, profitability. Your risk management does, right? And by risk management, I don't mean just have, the normal BS, like have a risk here, have the reward here, like RR and win rate. Like, all those concepts are important, but in algo trading, we usually use advanced risk management systems. Okay, so a Medicure strategy with excellent risk controls outperforms a brilliant strategy with poor position sizing. Extremely important. Okay, professional systems spend more code on risk management than on signal generation. Risk is not an afterthought. You don't have to think about risk after you've done the strategy. You have to think about the risk while you're making the strategy, while you're making the system. It's the foundation of your algorithm. Okay. Then comes in these things. So, for example, there are few ways to manage risk, and a few of the important ways I've noted down here. So position sizing is like the normal thing, never risk more than X% of capital per trade, and you can use fixed fractional or volatility adjusted sizing. Okay, and then there's drawdown constraints. So, for example, if the account drops Y%, halt trading, so you stop trading, and this protect against like huge losses and psychological damage that you would have after getting an email from your algo that you've just lost this much amount of money. Okay, so then you have the kill switch logic. So it's basically automated circuit breakers for abnormal conditions. So, for example, your a kill switch logic works like this. Let's suppose there are system errors coming from your API that is connected with your exchange. Then what would happen is you would just shut your algo down. You would kill your algo for the meanwhile temporarily. So that's what a kill switch logic is. And then you have portfolio heat. So this is like a heat map. So it tells you the total exposure across all positions, and this prevents overconcentration and correlation blowups. Okay. Then execution reality check. So backtest assume perfect fills at closing prices. Reality involves slippage, partial fills, rejected orders, and latency. These things, can really destroy your algo profits. So ignoring execution costs is how profitable backtests become losing live systems. So then there's the main four things. There's latency, so time between signal generation and order hitting the exchange. Price can move during this delay, right? This may seem like a little delay, but this is huge when you're trading with algorithms. So then there's slippage, so difference between expected fill price and actual fill price, worse in volatile or illiquid markets. And then there are partial fills, like order only, partially executed due to insufficient liquidity, leaves you with unintended exposure. And there are like edge rejections, orders are rejected due to insufficient margin, exchange errors, or rate limits. System must handle these things like gracefully. Okay, that's why you need to have like if and else conditions in your code, or like try and accept, right? So model execution costs conservatively in backtest add 0.1 to 0.5%. I'm like, what I do personally is I just add 1% slippage. I don't even go this conservative. I go extremely conservative, like with adding 1% or 2% slippage per trade, depending on liquidity. If your edge disappears, it wasn't real, right? Okay. Backtesting that is not fake. So most backtests are exercises in self deception. They overfit to historical data, ignore execution cost, and assume perfect information. Professional backtesting is about stress testing assumptions. You need to stress test your assumptions, not maximizing historical returns. So there are three, modes that I would say you should go on. One is work forward methodology. So train on period A, test on period B. So for example, if you have a training data set of like January, then you don't want to, test it on the same training data. You have to test it on a new data set. So on like period B, or let's say if you have a training data of January, then you need to test it on like April or March or February, right? So never optimize on the full data set. Then there's like stress test assumptions. What if slippage doubles? What if volatility halves, right? What if correlation breaks? So have a lot of what ifs and test it, so your assumptions can be proven. Metrics that matter. In reality, total return or like the ROI, that's not the most important thing. You have to focus on Sharpe ratio or like Sortino ratio and maximum drawdown and win rate versus payoff ratio and consistency across market regimes. That is really important. Okay. So here's like a model that you can copy. So you have the training window. So fit the model on past data. Model is aka your strategy, on the past data, and then test it on a new data. And then you would have to do walk forward analysis. And then you just repeat this for different assumptions. So iterate to stress test robustness. And then you have simple strategy family one. Now we have the strategies family, right? So what are the main categories of strategy that you see in algo trading? Okay. So number one family is mean reversion. So mean reversion assumes price deviations from average are temporary and will correct. So it works in range bound, low volatility environments, but it dies in trading markets. Okay. So mean reversion is just like, if price is at $1 and $2, so you would expect it that it would just range in that range for a good amount of time, and that's mean reversion. Okay, so it works when the volatility is stable, defined range, high liquidity instruments, absence of persistent trend or structural change. These are only conditions where mean reversion works. And then when it dies is basically breakouts, regime changes, trending markets, volatility spikes, so price keeps moving away from the mean. So then the third one is regime awareness. This is very important for you to know what regime you are in. So filter trades using volatility measures like ATR, Bollinger Width, and these are the simple ones, right? Or trend indicators. Or you can also measure it with Z-score, and I would recommend using that as well, or testing with that. So don't fight persistent momentum. Okay, you don't want to fight the momentum when you're trading with mean reversion. An example is like buy when price touches lower Bollinger Band, sell at middle band, and you can add filter of like ADX to detect the regime. So all these things. Now the family two is momentum and trend. So momentum strategies bet that recent price direction will continue. Trend following extends this over longer time frames. Okay, usually that's what happens. So both require persistent directional movements and fail in choppy range bound markets, right? So when like momentum and trend is working, mean reversion is not usually working, and vice versa. So an example would be enter long when 20 EMA crosses above 50 EMA and ADX is higher than 25. And you can use, for example, let's say a trail stop using ATR based distance and exit when ADX drops below 20 or opposite crossover occurs. Okay, so this is the general idea behind momentum and trend trading strategies. Okay, so conditions required are strong directional move, expanding volatility and volume confirmation, absence of immediate resistance or support, or aka mean reversions environment. So to avoid chop, you can again use z-score or you can use ADX, and also you can use the average of price, aka moving average, to avoid sideways markets and exit quickly when momentum stalls. Just give me a second, let me drink some water. So simple strategy family three is Volatility and time. So volatility-based strategies exploit expansion and contraction cycles. So time-based approaches capitalize on predictable session patterns, news releases, or intraday liquidity shifts. Okay. So time windows and sessions is basically like, for example, London Open and New York Open and it's an Asian session. Each session, each time window has a distinct volatility that is consistent, usually over a long period of time, and liquidity profiles. Okay, so for example, if let's suppose if London Open is usually bullish on your asset, then you can try to trade only bullish conditions on that time window. Okay, and also you can use sessions as a regime detector as well. Okay, and then you may have volatility filters, so you can use ATR or Bollinger Band width to qualify trades. High volatility, momentum usually works, and low volatility, mean reversion works. So you can also diversify between these two strategies. So you can have a momentum strategy, and you can also have a mean reversion strategy. So if one works, the other doesn't. And then you can try to have a portfolio risk management. So even if the other one doesn't work, you can still try to reduce your risk and make more money. Okay. Then there's event-driven timing. So, for example, you have to avoid trading during major news releases unless strategy explicitly exploits volatility spikes. Okay, and then we have practical arbitrage opportunities and reality. So, what's the actual reality of all those videos that you see on YouTube or on Twitter? You see tweets that like you should exploit arbitrage opportunities. So I'm gonna go over the reality over this. So arbitrage in general sense is just buying from one exchange, selling to another exchange, or within that exchange you can also do arbitrage. I'm going to go over later on, but the general idea of arbitrage is buying low, selling high. That's just what arbitrage is. Okay, so true arbitrage is extremely rare and capital intensive. So what retail can access are like arbitrage edges with embedded risk, so which are over here. So funding and carry edges. So for example, you can exploit funding rate differentials in perpetual features, which is in only in cryptocurrencies, or you can also do carry trades in forex. It requires capital, like a good amount of capital to make good amount of money, and it also requires risk management. So also you can do cross venue price differences like buying on exchange and selling on exchange B, but usually it doesn't work because institutions are already doing this, and the difference is extremely low most of the time. So and also you have to be sure of counterparty risk, because recently, like FTX, a crypto exchange, just went down. So that's what a counterparty risk usually is. So then you also have triangular arbitrage. So it exploits currency pair mispricings. So for example, USD Euro and then Euro GBP and then GBP USD loop, right? But this would require a sub-second execution, which again, that's why we're learning about algo trading, right? So there's one little warning. Don't get too excited. Like if you have a small budget and small resources, don't get too excited by HFT and latency arbitrage. But if you're an institutional player, then you should get excited about this because you can do this, right? Feature engineering mindset. So features are transform inputs that help systems detect patterns. Good feature engineering separates profitable strategies from noise fitting exercises. Poor feature engineering guarantees overfitting. So, what basically features are? Features are basically derived metrics from price, volume, or time. Example would be like RSI, moving average crossovers, volume weighted price, time since last high, right? This is what an example would be. What to avoid is basically look ahead bias, data snooping, excessive parameter optimization. So if your feature like needs 7 parameters tuned to decimal places, and then most probably it's an overfit. So it's just telling you a lie that you're profitable in your backtest. So leakage and overfitting. Leakage is using future information in past decisions, right? And you have to be very very sure about this, that you're not leaking in your algorithmic trading or in your backtesting specifically. Overfitting is feature works perfectly on historical data, but it fails live because you're because what happens is that in your backtest it will work perfectly fine, but it would fail in live trading. That's because you're probably a victim of overfitting in your data set. So you need to be sure of your data processing and the way you're doing backtest. So keep features simple, interpretable, and economically justified. So if you can't explain why a feature should break price, it's probably just, false. um, a professional system architecture. So professional algorithmic systems are modular, testable, and resilient. Each component has a single responsibility and fails gracefully. Monolithic code is unmaintainable and fragile. So number one would be data layers. So for example, ingest, cleans, and stores market data. It handles missing values, outliers, and exchange downtime, right? And then the second would be in your architecture, it would be signal generation. So in this like component of your architecture, you calculate like your signals, your you do your evaluation of your entry exit rules, and then you generate trace signals, right? And then the risk management is basically position sizing, exposure limits, drawdown controls, and all those things. It actually vetoes trades that violate, risk rules. So then you have the execution engine. So it route orders, handle retries, manages partial fails, interface with Exchange APIs. And then you have the monitoring and alerts. So it tracks the performance, email, you or WhatsApp you the performance, and monitors the algo, and then send you alerts and logs everything for post mortem analysis. So now we get to the checklist professionals use before deployment. So amateurs usually would, deploy when backtests look good, and they would just rush into deploying their algorithms, which is not good. Okay, professionals deploy when failure modes are documented and mitigated. So this checklist would prevent you from huge losses or, just being sad. So failure modes would be, what if the Exchange API fails? What if orders are rejected repeatedly? What if position size exceeds margin? What if latency spikes to 5 seconds? And you have the guardrails over here. So monitoring and alerts, you should be having real-time P&L tracking. You should be doing alerts for abnormal drawdown and system health checks every minute, and automatic shutdown on repeated errors. Run the system in paper trading for at least 30 days, or you can do it for 15 days as well. And then you have to test it with small capital for another 30 days. Only scale when behavior matches expectations. So a simple example system end to end is, let's say you have to define an idea, you define the rules, you define the risk, you define execution assumptions, and you define what breaks it, right? And then you test all of these things, and then you have an algo that you can actually work with. So learning roadmap from zero. So what is the roadmap for you guys? Is basically the first 30 days, just focus on the foundations. YouTube, Google what market structure basics are. You can just go on and learn more about these things. You have to learn more about order types and execution. You should read this book by Larry Harris, Trading on Exchanges, and Paper Trade Manually to understand execution as well. And then the next 30 days, you should be doing system design. So risk management frameworks, position sizing mathematics. So you should be reading this book by Systematic Trading by Robert Carver. It's a really good book. And design, you just use your pen and paper and design 3 complete systems on paper. Okay, then you have the knowledge to actually be able to design systems. And then the next 30 days, you can do the implementation. So for example, you can learn Python, or you can learn Rust or C if you want more speed. And then you have to learn backtest frameworks. For example, if you're using Python, you can learn vector BT and all those things. And you can also, like make your own backtesting framework